You're watching Good Day Tampa Bay.
8:44, and it's time to talk about the big story on Wall Street. Friday, the Dow jumping 307 points, capping off a turbulent week. And investors hope that that rally will continue tomorrow, especially after the recent red flags about a possible recession. And to get some perspective on this, I want to bring in John Troncoso, a certified financial planner. John, thanks for being with us. We'll start with the biggest question and maybe the hardest question to answer. Are we inching closer toward a recession?
Sure. So the short answer is yes. We're undergoing the longest economic expansion in history, 121 months. I want to be very clear, though, I'm not saying that we're at end of cycle, just the later stages of the cycle. I don't know if what we were seeing in the markets this week is really the canary in the coal mine. I don't think we're there yet, but it's kind of like when people go on to WebMD to self-diagnose. Don't hit the panic button. Make sure you're just calm and collected. To put things in perspective, the markets are 5% off highs, but we're still up 15% year to date, which is pretty good. Globally, the picture's faltering somewhat. Economies like Germany, the UK, China, they're faltering. And I think Argentina actually had a day last week where they were down 50% in their stock market in dollar terms.
So if a recession is coming, would that be what's driving it, all the lack of stability in these global markets?
Yeah, I think so. The big headline from last week, I think, was yield curve. And what that simply means is that the shorter term rates are now paying more than longer term rates. And that's usually indicative of investors souring on short term prospects in the market. These things have not been such an issue historically in recent times. Such positive news, economic news, has really allowed investors to shrug off these issues. But I think lacking consumer confidence, higher debt levels, a housing slowdown, and unemployment bottoming are kind of weighing on investors' minds.
And when we think about recessions, when we talk about recessions, people sometimes immediately think of the Great Recession of 2008. Right. That might not necessarily be where we're headed. Can you explain why not to panic? Sure.
So I think there's a behavioral issue there, that whatever's happened most recently is typically what people think it's going to happen in the future. But I think that the big thing to remember is you shouldn't be panicking. A knee-jerk reaction is not what the doctor ordered, and market timing is extraordinarily difficult to pull off successfully. It's not a light switch. It's not binary. We're not either risk on or risk off. And instead, I recommend really tactically allocating your equities. And what I mean by that is perhaps focusing less on these high return areas of the stock market instead of looking at some of these safe havens, treasuries, gold, utilities, healthcare.
So maybe pulling back from your stock exposure and kind of ramping up the bonds, especially if you're closer to retirement right now.
Exactly right. And everybody's situation is a little bit different. So a retiree is not going to be in the same boat as you and I. They have less time to recover in the case that the market does turn to the worst. They're constantly pulling on their accounts for money. So I think that's a very bad situation. You certainly want to pare down your risk slightly.
It's an interesting time, I think, for millennial investors who maybe for the first time in their adult lives, as people contributing to 401ks, are seeing this volatility in a way that, maybe they were in high school when the 2008 recession happened. So maybe just in a nutshell, your advice to them.
Yeah, I think the biggest piece of advice is don't panic, kind of like what we mentioned before. And Vanguard has a really interesting study on the value of a financial advisor. And they actually quote 3.75% per year that a financial advisor can help you. And largely that's working with somebody with a plan. When the markets are undergoing turmoil, it's best to be able to think ahead and kind of what's going to be our reaction in case things do go awry.
And if you decide to dip your toe into that, meet with a financial advisor, you don't have to necessarily commit to meeting with them all the time. You can just do one time and get some good advice there.
Exactly right. Most financial advisors are more than happy to look at your portfolio and diagnose your risk. And I think that's something that's really important to understand. I always advise the what if test. If the markets were to go down by 40%, what does that mean for my portfolio? And additionally, how am I going to react? So it's kind of that behavioral finance that's really important there.
All great advice. John Troncoso, thanks so much for being with us.
Thanks so much for having me.
Appreciate it.